What are derivatives? Answer is: in the world of finance, derivative is a type of financial product whose value is linked to the underlying assets. Underlying assets meaning in a derivative or warrant is that it is a type of security, property, or other assets that influences the value of the derivative or warrant. For example, in an option giving one the right to buy stock in Johnson & Johnson, the underlying asset is the stock in Johnson & Johnson. The derivative is a bond between two parties and its value is derived from the fluctuations in the underlying assets. Types of derivatives. Forwards contracts. This type of derivative is a custom-made contract between two parties in which the settlement between the parties takes place in the future on any decided date. The price is decided beforehand and at the same price, the deal is made in the future. So when there are such future settlements between two parties to buy or sell an underlying asset, it is called a forward contract. As mentioned earlier, the contract is customized, hence the size of the contract is dependent on the term of the contract. These types of derivatives can be self-regulated and collateral is not required. Future contracts. Futures contract is quite self-explanatory and similar to forward contracts. It is a deal made to buy or sell an underlying asset at a specified price on a future date. In the futures contract, there is no need for the parties to meet each other to make the agreement. The counterparty risk factor in future contracts is low as the settlement is standardized. As it follows a standardized contract, the regulation is taken care of by the stock exchange, and the size is also fixed. To sum up, the future contracts being standardized has the preset size, preset expiry date, and preset format. Options contracts. The features of options contracts are quite dissimilar as compared to the above two types of derivatives. In the other types of contracts, there is no mandate to discharge the contract on the specified or decided date. In this type, the parties can opt to buy or sell the asset but are not obliged to do so. The option contract is also divided further into two types, namely call and put. When the buyer party has the right to purchase the asset at a predetermined price when the initial deal was made, it is called a call option. Whereas in the put option, the buyer party can buy the asset but not obliged to sell the asset at a pre-decided price. Swap contracts. Out of all the above various types of derivatives contracts mentioned above, the swap contracts are the most complicated. These contracts are made between the two parties privately. The parties decide a predetermined formula and exchange their cash flow according to the formula in the future. The risk parameter in swap contracts is high as the underlying security is the interest rate or currency.